I want to start with a number, not because numbers are dramatic on their own, but because this particular number has a specific property that most financial commentary is failing to communicate clearly enough to matter. The United States government currently carries a national debt approaching $40 trillion. The annual deficit, the amount by which spending exceeds tax revenue in a single year, is running at approximately $2 trillion. Interest payments on that existing debt have now crossed $1 trillion annually, exceeding the entire defense budget as a line item in the federal budget. And the debt is growing at a rate of approximately $7 billion every single day, not in a crisis, not during a war. On a Tuesday afternoon, in what the official statistics describe as a period of economic normalcy, those figures are reported. They appear in Congressional Budget Office projections, in Treasury Department disclosures, in Federal Reserve financial stability reports. They are not hidden. They are not classified. They are available to any American who chooses to look at them. You can find them on government websites with a single search query. And yet the most important thing about this debt, the mechanism by which it will ultimately be resolved, the specific and predictable way that resolution transfers wealth from one group of Americans to another, and the timeline over which that transfer is already occurring, is almost entirely absent from the financial coverage that reaches ordinary investors and savers. That is the secret, not the number itself, the mechanism behind the number. And the reason it is a secret is not that governments are concealing it, it is that the mechanism operates slowly enough and quietly enough that it does not generate the kind of dramatic headlines that would cause people to recognize it as the thing that is happening to their savings in real time. After 5 decades managing capital at JP Morgan Chase, navigating multiple debt cycles and watching governments across the world face versions of the same arithmetic, I can tell you precisely how this resolves. I can tell you who bears the cost, and I can tell you why the resolution is already underway in ways that most people are not recognizing as such, because it does not generate the kind of dramatic headlines that would prompt them to pay attention. What I am about to describe is not a prediction. It is a historical pattern documented across every major economy that has faced a debt burden of this magnitude that is now being applied to the United States in real time. Understanding the mechanism is not pessimism. It is the prerequisite for making decisions that protect what you have built. Why the number is not the secret. The debt figure itself, $35, $38, $40 trillion, is the wrong focus. It is a large number, and large numbers produce an emotional response that substitutes for analytical understanding. The relevant question is not how large the number is. The relevant question is what the only realistic options for resolving it actually are, and which of those options the political system will choose. There are, in principle, 4 ways to resolve a debt burden of this magnitude. You can grow your way out of it, expanding the economy fast enough that debt shrinks as a percentage of GDP even as the absolute number grows. You can tax your way out of it, raising revenue until the gap between spending and income closes. You can cut your way out of it, reducing expenditures to the point where you run surpluses that gradually pay down principal. Or you can inflate your way out of it, allowing the real value of the currency in which the debt is denominated to decline until the fixed nominal obligations become manageable in real terms. The first option, growth, requires the economy to expand faster than the debt is accumulating. At current deficit trajectories, that would require sustained real GDP growth of 5% or more annually for decades. The United States has not achieved that consistently since the post-war expansion of the 1950s and early 1960s, and the structural headwinds of an aging population, slowing productivity growth, and elevated debt itself are not consistent with that trajectory. The second option, taxation, requires tax increases of a scale that no modern democracy has successfully implemented without triggering the economic contraction that reduces the very tax base it was designed to expand. The United States would need to increase federal revenue by approximately 30 to 40% to close the structural deficit gap. The political system has demonstrated repeatedly across administrations of both parties that this is not achievable. The third option, spending cuts, requires touching the 3 categories that constitute the overwhelming majority of mandatory and discretionary spending: Social Security, Medicare, and defense. Combined, these categories represent approximately 75% of the federal budget. No administration has successfully reduced them in real terms over a sustained period. The political consequences of attempting to do so are severe enough that no elected official in either party has seriously proposed the scale of cuts that would be required. Which leaves the fourth option, and this is the secret: financial repression, the tool that works without a vote. The fourth resolution mechanism is called financial repression. It is not a theory about what might happen. It is a documented, historically tested policy tool that governments use when their debt becomes structurally unmanageable, and the United States has used it before, deliberately and systematically, for nearly 3 decades after World War II. Here is the mechanism precisely. Financial repression occurs when a government keeps the interest rate it pays on its debt below the rate of inflation. When the real interest rate, the nominal rate minus inflation, is negative, the debt's real value erodes over time. A government that owes $1 trillion at 2% interest while inflation runs at 4% is effectively paying a negative 2% real rate. Every year, the real burden of that debt shrinks by the difference between the nominal interest rate and the inflation rate. The debt does not disappear. It is not canceled. It is not defaulted on. It simply becomes worth less in purchasing power terms, which is another way of saying that the people who hold it are quietly paying the cost. Those people are primarily savers, bondholders, pension funds, and anyone whose wealth is stored in dollar-denominated fixed income instruments. The wealth transfer this mechanism produces is not visible on a daily basis. It does not generate a headline on the day it occurs. It does not produce a market crash that creates a clear before and after. It accumulates silently, compounding backward, reducing what saved money can actually purchase year after year. The saver who holds a 10-year Treasury bond earning 3% while inflation averages 5% over the bond's life has not experienced a default. They have experienced a 2% per year reduction in real purchasing power, delivered gradually and invisibly in a form that most people don't identify as a loss because the nominal balance never declined. This is not a new mechanism. It is the mechanism the United States government used between 1946 and approximately 1974 to reduce the post-World War II debt load. At the end of the war, U.S. debt to GDP ratio stood at 106%, comparable to today's trajectory. By 1974, that ratio had fallen to 23%, not through explicit default, not through dramatic austerity, not through unprecedented tax increases, through a sustained period of moderate inflation running consistently above the interest rates the Treasury was paying, combined with the economic growth of the post-war expansion. The mechanism worked, the debt burden was eliminated, and most of the Americans who lived through it did not experience it as a policy being implemented. They experienced it as the cost of living going up, as their savings buying less than they expected, as the gap between what they had saved and what they needed to fund their retirement being larger than they had planned for. That is the secret. The resolution of the current debt burden will look like inflation. It will feel like prices rising. It will register on your monthly statement as a positive nominal return that is in fact a negative real return. And it will transfer purchasing power efficiently, silently, and at scale from the people who saved in dollar-denominated instruments to the government that issued those instruments. The difference between 1946 and today, now here is where I need to be precise, because there is an important analytical distinction between the post-World War II financial repression episode and the current situation, and that distinction has direct implications for how severe and how disorderly the current resolution is likely to be. In 1946, the United States was the world's dominant creditor nation. It had emerged from the war as the only major industrial economy with its productive capacity intact. The rest of the world needed dollars to rebuild. Demand for dollar-denominated assets, including U.S. Treasury securities, was organic, structural, and enormous. When the Fed and Treasury suppressed interest rates below inflation, foreign and domestic buyers continued to hold Treasury debt because the alternative, holding the currencies of devastated European economies, was worse. The United States had effective pricing power over its own debt in a way that has not been replicated before or since. Today's situation is structurally different in several critical respects that increase both the difficulty and the potential disorder of the resolution. The United States is now a net debtor nation with a net international investment position of approximately negative $26 trillion. The dollar's share of global central bank reserves has declined from 71% in 2001 to under 58% today, and that decline is accelerating. Foreign central banks, the most reliable buyers of U.S. Treasury debt for decades, are systematically diversifying away from dollar assets and into gold and alternative reserves at a pace not seen since the Bretton Woods era. The buyers who have stepped in to replace foreign central banks are primarily domestic. The Federal Reserve itself, domestic commercial banks, and retail investors through money market funds and bond ETFs. These buyers have different risk tolerances, different return requirements, and different responses to the inflation dynamics that financial repression requires. They are not captive buyers in the way that dollar-dependent post-war economies were captive buyers in 1946. This means the interest rate suppression required for financial repression to work is harder to maintain today than it was in 1946. The bond market will periodically resist suppression below inflation levels, generating the kind of yield spikes that produce significant losses for long-duration bondholders. The 2022 bond market, the worst year for U.S. Treasury bonds since the Civil War era, was a preview of what those resistance episodes look like in the current environment. What is already happening? The financial repression mechanism is not a future scenario. It is a present reality that is operating in ways most people are not identifying as such. The Federal Reserve is cutting interest rates in an environment where inflation remains above its 2% target. That is the textbook definition of financial repression in real time, reducing the nominal interest rate the government pays on its debt while allowing the inflation that erodes the debt's real value to persist above it. The policy is being described publicly as monetary normalization. Its structural function is debt erosion. The Treasury Secretary of the United States has publicly described the current period as a Bretton Woods realignment and has explicitly discussed the goal of depreciating the dollar to address trade imbalances. A deliberate dollar depreciation of 20 to 40%, which has been discussed within the administration, is another mechanism for the same outcome, reducing the real value of dollar-denominated obligations by reducing the real value of the dollar itself. Simultaneously, regulatory changes are being pursued that would create new mandatory demand channels for Treasury debt, requiring stablecoin issuers to hold treasuries, adjusting bank capital rules to favor government bond holdings, expanding the categories of institutional investors required to maintain government debt as a reserve asset. These mechanisms reduce the market's ability to resist interest rate suppression by engineering artificial demand for government obligations at rates below what free markets would require. These are not random or uncoordinated policy moves. They are the institutional expression of a government that faces an unsustainable debt load and is implementing across multiple policy dimensions simultaneously the only resolution mechanism that does not require a congressional vote and does not generate the kind of immediate political consequences that explicit default, dramatic austerity, or massive tax increases would produce. Who pays and who does not? The financial repression mechanism transfers wealth from a specific group to a specific group with a precision that is rarely acknowledged openly. The group that bears the cost is unambiguous. Anyone whose wealth is stored primarily in assets with fixed nominal returns. Cash and savings accounts earning 3 or 4% while inflation runs at 5 or 6% is a guaranteed loss in real terms. Long duration bonds, 20-year Treasury ETFs, any bond fund with average duration above 8 years are exposed to both the interest rate volatility that resistance episodes produce and the inflation that erodes their real value over the bond's life. Fixed annuities, stable value funds, money market instruments, any asset whose return is defined in nominal rather than real terms faces the same headwind. The group that does not bear the cost, and in many cases actively benefits, is the holders of real assets. Equities in companies with genuine pricing power, the ability to raise prices as their costs rise, performed well during the post-war financial repression era because their nominal earnings rose with inflation even as the currency used to measure those earnings declined. Real estate with fixed-rate mortgage financing was an extraordinary beneficiary. The real value of the mortgage debt eroded while the real value of the property held, producing a leveraged return on the inflation dynamic. Physical assets, gold, productive land, commodity-linked equities, retained their real value in a way that paper claims on fixed cash flows did not. The pattern is consistent across every financial repression episode in the historical record. The investors who understand the mechanism and hold assets that are not exposed to it preserve their purchasing power through the transition. The investors who hold cash and bonds because they appear safe experience the quiet cumulative erosion of what they spent their lives accumulating. The signal most people are missing is not in the price of gold itself, it is in the behavior of the institutions that understand better than anyone else what the price of gold is actually measuring. Central banks globally purchased over 1,000 tons of gold in 2025. The buyers include Poland, China, India, Kazakhstan, Turkey, Brazil, the Czech Republic, institutions across entirely different political systems, economic models, and relationships with the United States, all independently arriving at the same allocation decision. Goldman Sachs has described this as the most aggressive central bank gold buying cycle in modern history. These are not retail investors reacting to YouTube content or financial media narratives. These are the institutions that employ the economists and analysts who study monetary history professionally, who manage reserves on multi-decade time horizons, and whose allocation decisions reflect considered institutional judgment about the long-term purchasing power reliability of the assets they hold. They have access to data that is not publicly available. They move slowly and deliberately, and they are all moving in the same direction at the same time. When those institutions systematically reduce their exposure to dollar-denominated government debt and replace it with physical gold at a rate that has not been seen in modern history, they are making a statement not about short-term gold price direction, about the long-term trajectory of the dollar's real value and the monetary mechanism they expect their largest debtor to use to resolve an obligation it cannot resolve any other way. The secret is not the number. The secret is what the number means for the mechanism that will be used to resolve it and what that mechanism means for the real value of every dollar-denominated asset you hold. Financial repression is already operating. The institutions that understand it are already positioned for it. The question is whether you are. The people who understood this dynamic in 1946 and held real assets through the subsequent 3 decades built wealth that compounded through the resolution. The people who held cash and bonds watched the resolution happen to them rather than for them. The mechanism is the same today. The arithmetic is larger, and the time between understanding it and acting on it is the only variable that remains within your control.